Guys, it's great to see you both. Darrell, I think we spoke last time about various metrics that suggest recession when bonds and stocks do equally poorly for a couple quarters in a row. I don't think, it sounds like you don't think Atlanta Fed is a lie.
No, I actually don't think it is, Carl. In fact, it's continued to deteriorate here, and we're still going to get June numbers out in July that'll probably deteriorate further. So you're likely, to Sarah's good point earlier, to put a technical recession in place, which means the negative 1.6% in Q1, and then probably something north of a negative 2% in Q2 is what it's looking like right now. Turn the page. What's interesting, Carl, is none of the indicators on the market are suggesting good things, and I think the real story today is probably in the bond market more so than the stock market. The 2 to 10 spread is 1 basis point away from inverting here this morning. People haven't paid attention, but high yield spreads have gone up 50% in the last 30 days. So they've gone from 400 over to more or less 60 or 600 basis points over, and widened about 70 basis points in the last week. So the bond market is telling you more things than the stock market is right now.
That's a great point, Urian. Some of the bulls argue that financial indicators overstate recession risk, but I wonder if you think actual macro indicators are starting to ratify it.
Well, they are starting to. I mean, we're clearly in a deep late cycle mode. The fiscal stimulus from 2020 and 21 has turned into a fiscal drag. We know that inflation is sort of cutting into disposable income. We're obviously all waiting with bated breath for second quarter earnings season, and I think it looks like from the tape in front of us that investors are selling first and asking questions later, because the market's fairly valued at 16 times forward earnings, but that's only as good as the forward earnings, of course. And so the earnings side, I think, really is the next big thing. But as you just pointed out, high yield is really kind of the canary in the coal mine right now, because the cost of capital is starting to fall across the board as the worries transition from inflation to growth. And so Treasury yields, mortgage rates, everything is starting to come down, except for the yield on the Barclays High Yield Index. That one is rising, and that clearly is a divergence that certainly me as a chartist is looking very carefully at.
I guess, Darrell, to a lot of the negativity that you spelled out earlier on the economy and what's happening with bonds, my question is, why isn't that bullish? We didn't like high inflation. We didn't like high bond yields. We didn't like high oil prices. That's all coming down now because the Fed is doing what it's supposed to do. And so if we don't have an inflation problem, sure, recession's not good, but bond yields moving south at some point, isn't that bullish?
Well, it's a great point, Sarah. It depends on why bond yields are moving south, right? If the curve on the long, intermediate long side is coming down because of concerns of pulling out any kind of a growth premium, right, which I think is what's happening here lately, that's suggesting, recession is more imminent. Don't forget, to the points made earlier, we're the most aggressive central bank on the planet. The ECB hasn't even started tightening conditions in a 8+% inflation world. The BOJ is still holding firm on yield control, and China is the most dovish central bank or large central bank on the planet. So we have a lot of work to do yet on inflation, and I think the bond market is starting to tell you that. Relative to earnings season, you're probably going to get 11-12% revenue growth, but only about 5 to 6% earnings growth, which tells you already this will be the first quarter of margin deterioration because of the math just in the income statement there. And I think we need to really watch forward consensus, because I think post the Q2 conference calls with CEOs and CFOs, those sell side numbers are going to get ratcheted down pretty materially.